All right, should we get it going?
Let's go.
Good morning, everybody. This is Kurt Brown, and I'm joined in the room here with Josh Flade and Monica Saunier, and we really appreciate everybody taking the opportunity out to spend a few minutes with us and on a summer morning and talk about the markets and the economy and kind of what's going on. And there's a lot going on. There's a lot of people still filing into the room here, but we're going to go ahead and get ripping. There's a Q&A button there, and obviously we'll do our best to monitor the questions as they come in. So as you guys have topics or things you want to bring up or maybe want us to elaborate on, we'll do our best. We've got a lot of topics here we want to cover. And then as well, as usual, we will send out by tomorrow a link to the replay of this call, as well as the PowerPoint slides themselves. And obviously feel free to share those with anybody that you think might be interested in that. And then as always, we welcome feedback. You know, we want to make the content better. We want it to be helpful to you in some way. And a lot of you, I see a lot of names in here from all over the country, and you've been joining our calls for a few years, and you know that I kind of have a bias around a lot of financial journalism being spin. And so what we really try to do is just show you the data, just show you the information. What is good? What is bad? What are we working off? Kind of what is the scorecard? And then maybe some actionable items for your own portfolio. And obviously, you know, working with your advisor is going to bring it to a custom level, but there's things that kind of apply to all of us and general rules of great investing. So let's dive in. Let's go through this, and obviously, like I said, go ahead and hit us up in the Q&A if we want to, if you want us to elaborate on anything or whatnot. So let's start off with the bad stuff, and there's plenty of bad stuff to go around. Some of this is a couple days old, but it's pretty fresh data here. The average stock in the United States that trades on our exchange is down between 35 and 40% right now. And the average NASDAQ and small cap stock are down over 50%. So when you look up and you see that the S&P 500 is down 20 or down 22, that's telling part of the story. But a lot of those big mega cap names have actually held in a lot better than the rest of the market. In fact, 30% of the NASDAQ is now down 75% from its high. You have heard me drone on and on for how many years now about zombie companies and generally companies with bad balance sheets, the kind of companies that probably shouldn't even be trading publicly. And a lot of those have been taken to the woodshed. And that's exactly why I spend so much time, and the rest of our team does, obsessing about owning really high quality investments. We're going to talk about that because when you get in the soup like we are right now, those types of companies don't typically hold up very well. And a lot of them have been absolutely hammered. And so as painful as it is for all of us to be in a market like this and watch our portfolios kind of draw down in value, for most of us, it could be dramatically worse. And that's why you really want to right size the types of investments that you own. And you really want to limit the highly speculative assets you've got in your portfolio. We recently had a period where the Dow Jones was down 8 weeks in a row. We're in a period as of last week where the S&P 500 was down 11 out of 12 weeks. We are getting into very rare air here. That hasn't even happened. That didn't happen in the Great Depression. You got to go back to the early 20s to have that happen. So like 100 years since that happened. Another thing that is very rare is just seeing bonds, and especially high quality bonds, be hit so hard at the same time with stocks. Because in a lot of bear markets where stocks get clobbered, people race into really high grade things like treasuries as a safe haven. There have been no safe havens. And it's one of the things that's made this extra painful this year, because usually in a 60-40 portfolio, and I know everyone's got like a different blend, but there's that, you know, there's that adage about just always owning a 60-40 portfolio. Usually the 40% that's in bonds is going to be behaving a lot better. But bonds had been in a multi-decade bull market, right? Bonds had just gone up and up and up. And with inflation and with interest rates going up, those bonds naturally have to sell off. So you have a lot of assets selling off at the same time. And that's why there's been so much pain. The other place that we're all feeling a lot of pain is just running around town and living our daily lives, right? I mean, we're seeing the inflation is absolutely outrageous over the last 2 years. And so when we look up and we see an 8% inflation number for the Fed, a lot of us are skeptical because we're like, it feels like a lot more. I look at what's happening at the pump. I look at what's happening in rent, or if I want to buy a car or something like that. And it's really been outrageous. So you're being inundated with this news already. So we're not going to drill down into all of the different components of inflation, but you're seeing what's been happening. Some of it is a little bit newer. Some forms of inflation are easing, and some are getting worse in the short term, right? Like you've seen with airlines. Anybody that's trying to fly this summer and go on vacation, you've never seen anything like this. It's just absolutely incredible what we're seeing in that part of the economy. Another thing, and Monica and Josh will both elaborate on this a little bit more, but rates had really moved higher and moved higher quickly, right? You saw mortgages move from under 3% to in the 6% neighborhood for a 30-year fixed. It's not that 6% historically is a really high number. It's not. But coming from where we have been the last 5 years, it's a really aggressive move. And we'll talk about that more in a second. This data that you see on the chart moves around on a daily basis. But right now, the Federal Reserve is basically lending money to banks overnight at about 1 3/4 interest rate, right? And they've moved that up from essentially zero, right, at the beginning of the year. So that's how much the Fed has actually moved up rates. But what the bond market, of course, does is it looks into the future and is pricing interest rates later. So by the end of this year, the bond market as of last week was pricing in something closer to 3 1/4 for interest rates, another 1.5%. We'll debate here today a little bit whether or not we're going to see that. Maybe actually we've overshot already and interest rates are trading a little bit too high. That's yet to be determined. But remember, you hear a lot of people in the media say, well, rates are going to go even higher. Well, the bond market has already priced in higher interest rates. So we might actually be peaking in terms of where short-term rates are. It's sort of dependent ultimately on what inflation does and what the Federal Reserve does. Other things that really have been problematic are these labor shortages, right? We are starting to get glimmers of hope here. This has obviously been very good for people that need to change jobs. They need a raise and things like that. And yet it's been a real problem for businesses getting access to workers, right? We are starting to see a little bit of easing here. There's even really high profile companies like Facebook that just last week told their employees they're going to lay people off. They better find people getting more efficient, putting in more hours, coming into the office and things like that. We're starting to hear more and more of that come from senior management just in the last month or two. So we hopefully are going to get some more normalization in the labor market. We're not talking as much right now as we were about Russia and Ukraine. It's obviously a massive humanitarian disaster, but even in things like fertilizer and wheat, it's a problem, right? We see that Russia and Ukraine combined are about a third of the world's wheat exports. We've really been worried about that. I've got some good news on that. I'll show you in a slide in just a few minutes. But this continues to be something that's on the radar that can add a lot of stress around the world, especially in emerging markets. One thing that's really interesting is that this drop in the stock market of 20 to 25% it's not the biggest we've ever seen. However, Americans have more and more exposure to the stock market because of things like retirement plans and 401ks, which are a lot more common than they used to be. So when the stock market goes down, it actually has a little bit more of an impact on the economy itself than it used to. So for example, this recent sell-off in how much stocks have gone down is pretty dramatic. And there haven't been a lot of periods where as a percentage of GDP, it's mattered so much. So this in and of itself is cooling the economy a little bit, just how much the stock market has come down and how much market value or market capitalization has been realized and damaged. And so it's one of the things that's actually going to contribute to the cooling. All right, let's talk about the things that are still good, right? We're still seeing really, really impressive earnings growth. Calendar year 2022 is just about halfway in the bag, and these numbers look pretty good. And that's not a massive growth in earnings, but a lot more than you would expect with everything that we're facing at the same time. A lot of inflation, interest rates going up, now a slowing economy, Russia, Ukraine, and Eastern Europe. There's a lot of headwinds, and corporations are still finding a way to grow earnings. And that continues to be very impressive earnings growth. And we love focusing on those earnings because they're not really something you can't really fake that, right? This is real, bottom line cash flow and income. Same thing with margins, right? You get up under the hood of these corporate earnings to see how healthy are these earnings. You would really expect that over the last several quarters, you would have seen profit margins coming down, given how much inflation there's been. The cost of everything has gone up. And so you think for corporations, their profits would be going down, or at least their margins would be going down. It's not what we're seeing. So far, corporations have been able to run very efficiently. They've been able to pass on the cost increases to those of us that are their customers. And so it's really interesting when you have a stock market going down as much as it has in the first 6 months of the year, but earnings are really not, and neither are margins. And what it means is the market is getting cheaper fast than it was earlier in the year. We'll talk about that in a second. One of the reasons we emphasize earnings so much, and a lot of you have heard me talk about this several times over the years, is when you look historically at stock prices, they are very, very highly correlated to the earnings themselves. So what you're looking at here is a chart that goes back about 75 years or so, all the way back to World War II. And it compares the earnings of the 500 biggest companies with the prices of those stocks. And you can see how highly correlated they are. There's periods maybe where they decouple a little bit, but for the most part, these travel in lockstep. And it's one of the reasons we obsess so much about earnings and earnings growth. Some other things that the media is not going to tell you is that the average balance sheet of the average household in America still looks pretty good. Now, it's not as good as it was, at the end of last year. So you're starting to find that households, their debt as a percentage of their income is going up a little bit, but we are still at multi-decade lows. We of course have seen people wanting to tap their credit cards a little bit more in the last couple of months with inflation the way that it is and whatnot. But so far, this is still a very, very healthy picture. Here specifically, just looking at that consumer credit, right? Those credit cards and whatnot as a percentage of our economy, it's barely moving. And again, we're back to levels where we were in the 90s. So we really had come off a period of time in our country where we were on a debt binge, and the average household is still not acting like that. It makes us better prepared for a recession. It means that a recession, unlike 2008, doesn't need to cut as deep. In 2008, no one had any cash. Credit was a real problem, and it really added tremendous stress to our financial system. We're just not seeing that right now. Here's another place that looks very healthy, and it's cash, right? When you go back to the financial crisis period, consumers, we were sitting on about $1 trillion in cash in the bank, and we have about $9 trillion. And really interestingly, over the past year, even with all of this inflation, we've not seen those cash levels go back down. They have stalled right around that $9 trillion mark, but that is a lot of cash in the system still. Again, that's a very bullish sign. It's also something that can add fuel to the next economic expansion we have. And I know it seems premature to talk about that today because we're facing things like inflation and a slowing economy, but these things are cyclical. And so at some point in the next 1 to 2 years, we're gonna turn the ship around and go back into a new economic expansion. And that cash will add a lot of fuel to that growth. Even banks, it has been many, many decades since we have seen our banks in this country in such a healthy condition. Look at this. We got to a place, okay, as we were building the house of cards for the financial crisis, where for every dollar that a bank brought in, they lent $1.05. Okay, that's not sustainable, right? We've all done that post-mortem on the financial crisis and how dangerous that was. Well, we're getting to a place right now where for every $1 of deposits that a bank brings in, they're only lending out 60 cents, right? So they have shored up their balance sheet to a degree where they don't even like it. Banks are trying to figure out responsible ways to be able to lend more money, and they just are having a hard time doing it. And so as a result, the good news is our banks are incredibly healthy, unlike anything we've seen in the last several recessions. So it's another thing that makes a possible looming recession coming, a little bit easier for us to handle. I want to bring Monica and Josh into the conversation now and kind of talk about what the real kind of the singular issue is right now. And what's interesting is for all of us, it feels negative and heavy because we're talking about things like, really high inflation that we haven't seen in 40 years. We're talking about simultaneously a slowdown in the economy, some supply chain problems and things like commodities and oil and things like this. So the news feels heavy, but we're actually working from a place where it's heavy because it was so good. So the economy got too good. And it's weird because it seems like the news is all bad, but we had an economy and earnings and labor markets and all this stuff that were just running red hot. So what the Federal Reserve is basically saying is that is a very dangerous position to be in. We have to do whatever we can to sort of slow down that economy. So Monica and Josh and I are going to run you through kind of a few things here and show you that even though it's painful, it's actually working. So I'm going to tick off a few, and then we'll have these guys tick off a few as well. So first of all, leading economic indicators, they don't flip negative very often because this is what you see as the front end of a recession, right? When growth goes negative, right? When our economic growth drops down, right? That's a recession. If that happens for 2 quarters, you're in a recession. So we are already seeing the front end of these leading economic indicators starting to go negative. There's a lot of inputs that go into it. Let me highlight a few. Okay. So here's manufacturing. Okay. So those that manufacture goods in our country are seeing orders slow dramatically and quickly, right? That's always the front end of an economic cooling. What about durable goods? Those big goods that you buy, washing machines and dryers and freezers and refrigerators and these kinds of things are falling off a cliff. Remember, we came out of COVID. No one could get their hands on anything. So we scrambled to buy stuff, and now we're going exactly the opposite direction with these durable goods. Even personal consumption. And a lot of people that work with the Fed will tell you this is one of their favorite pieces of data to watch, okay? And when it says the word real, all that means is just if you take the inflation out. So another way of saying this is just the number of units being sold or purchased, right? So coming out of COVID, everyone scrambled to buy things. And now we're flipping it around and going exactly the opposite direction. So we actually see people buying less stuff than they were in the last couple of years. That's what's leading us into sort of this slowing.
Kurt, I might add something in here. I've been feeling a lot like things are cooling down a lot in various areas of the economy, just from an anecdotal standpoint. For instance, this 4th of July weekend, it seemed, the places up near where I live, where normally we would have seen tons of RVs driving up and the campgrounds filled to capacity, it almost seemed a little dead. There weren't that many people out. And I thought, I guess the price of gas has to be curtailing a lot of that. It's got to be pretty expensive to drive an RV a couple hundred miles. You used to, before pandemic, see always lots on the side of the road with used cars for sale, right? All the time. Totally went away when all of the demand for used cars went up. Well, they're back. Now I'm seeing tons of, used cars on the side of the road. And, that and just some of the things about, people who are trying to sell homes right now, all of a sudden they're seeing, traffic come to a total dead stop. They're having to cut prices. So it feels like a lot of the corners of the economy are just, ahead of some of these numbers.
100%.
Really starting to cool off.
Yeah. And we're really at the front end of it, but I totally agree. We're seeing a lot of this kind of front end behavior. You even see it like in some of the commodity prices. Like you look at lumber and cotton prices are just rolling over hard and fast. And what's so interesting about it, in fact, let me show you a couple other, and then we'll kind of talk about it. Used cars. This was a major problem. To Monica's point, I was on a car lot last week and they're giving out incentives. We haven't seen incentives to buy a new car. Like, here, we'll give you $5,000 off this truck. I'm kind of looking for a truck. And they're like, we'll give you $5,000. I haven't heard that like a car incentive in like 2 years, maybe more, maybe 3 years, right? Um,
And I mean, oil's down 20% in the last month.
yeah. What did we get to? 124, 125 a barrel?
130 was the
130,
highest,
did we get in
130
there?
was
Yeah.
the peak, right?
And what we got down as low as 90.
We're like sitting at 95, 96 today.
Yeah.
So
Yeah,
it's
yeah.
Fast.
maybe a little south of that, yeah.
And you made the
We're
point
at
that even discounts are being offered out into the market.
Yeah.
Right,
Yeah,
on
I mean,
crude.
yeah, I mean, obviously, right, Russia is discounting their oil in order to incentivize China and India to buy it. But then also now you have Iran, which kind of runs on a little bit of this kind of black market space too. And so Iran is now having to discount it even more than they were already discounting, because now they're competing with Russia. It's creating a very interesting environment.
What's funny about this is one of those weird spots where from a political standpoint, we need to stick it to the Russians, but the gray market may actually come out and help us.
Yes.
All these guys trying to trade oil in the gray market, right? Semiconductors, look at this. It was a major, major problem for us coming out of COVID. Remember, nobody could get chips. This is why all the Ford trucks sat there on the lot waiting to be sold. This is one of the most staggering things I've seen. So a third of the world's wheat production is out of Ukraine and Russia from an export basis. And wheat is making a low since the war started. Right? Wheat is breaking down. I mean, what does that tell you about how quickly things are slowing, right? Here's a place where you have a major supply problem.
And that's the last place where demand should slow down. Like people have to eat.
Absolutely. And this is stunning. Yeah, stunning. So we're still reading inflation data that's red hot from Q1 and Q2, but the high frequency numbers and the commodity prices and stuff are all aggressively coming in. This one is super interesting to me because we haven't seen this in a long time. Okay, this is year over year, so 12 months. This shows the biggest retailers in the United States, how much they have built their inventory. So we all were victims of inventory problems coming out of COVID. We have the pendulum now has really swung the other direction. So this is an order. Walmart and Amazon, of course, are the two largest retailers, right? Walmart in 1 year, their inventory increased by a third. You think of how much inventory that is for the world's largest retailer to build 1/3 of inventory in 12 months, and their sales were only up 4%. And when you think about it, inflation was up 8%. So their sales were actually down.
Yeah.
Right? Unit sales were down, right? And then their inventory, look at Amazon. If you aggregate Amazon retailers, their inventory is up almost 50% in 12 months. Okay. Just that information right there says prices at least have to cap or stall. They don't have to crash back down, but you do have to start getting an equilibrium, right?
Yeah, the supply side, and we were going to talk about this a little bit later, but the supply side that has been driving the inflation, which has really driven 2/3 of the inflation number, is now going away.
Yep, exactly.
And so you should see inflation start coming down.
And and it's been a long time in the making. We've waited how many quarters to get a little relief from the supply chain problems? But even in housing, in the history of the United States, at any single given moment, there's never been so many homes under construction as there are right at this moment. I mean, that's incredible.
Yeah.
And then the number of homes listed for sale is finally ripping. We needed this. We needed a two-way market. We needed more supply coming on. It happens in conjunction with a 22-year low in mortgage applications. So, buddy of mine, this is anecdotal, but he runs an inspection company. So you're going to sell your house, you get an inspection done, you're going to buy a house, whatever. So 8 weeks ago, he said they were doing 25 a week, and last week they did 2 inspections.
All the mortgage lenders, I mean, Wells Fargo, all the big banks, they're all laying people off.
Yeah.
They just know mortgage applications have dropped.
Interesting that it's even lower than right after 2008.
I know.
I
mean, and it's really, now, I think it's important that we clarify, we don't see a crash coming in housing. We still actually have a shortage of homes in this country for the number of people that need them.
Yeah.
But this is actually a good thing because it's gonna help inflation cool, but it's also gonna give a two-way market to housing again. Like a buyer can buy something. Like it got to the point where it was completely insane, right? So we needed some cooling in here. Even price cuts. We were running where almost no homes that were listed on the MLS had ever had a price cut. And now we're running at like 30%. Anecdotally, some friends in the neighborhood, they've dropped the price of their home just in the past couple of weeks by like 10%.
Yeah.
because they were really fishing for some crazy person to come buy their house at an outrageous price,
Utah County, 50% of their homes dropped prices. I think last month is what the data was, which is crazy. So that would have been May, not June.
And we're seeing the same thing actually in Phoenix and Boise, some of the other really super hot Western markets.
Retailers are saying that the foot traffic of people just going out looking at homes just dropped dramatically right around May. It just plummeted.
Well, I mean, the reality is it's almost twice as expensive to buy a home as far as like your monthly mortgage payment as it was at the very beginning, when interest rates had dropped, when COVID first hit.
Oh yeah.
And so it's
just, because you've had
expensive.
The mortgage costs are double.
Yeah.
But then the median home price is up another 50%. Yeah, exactly.
I think this also highlights something that we talked about early on when inflation was popping up, about how the cure for high prices is high prices. And I think to a large extent in many areas, we're seeing that now, the slowdown in cars and in all of the inventories.
I think Monica, I think you're right. There's like an exhaustion a little bit. And so you have a lot of people getting off the accelerator at the same time. This is really stunning. Okay. Since the end of April, okay, look at this. The cost of getting a container to ship goods from China to the United States is down over 40%. Think about that. This was the period where Shanghai was shut down.
Yeah.
A lot of China was closed, and you still had container rates plummeting. Like, that's exactly the opposite of what you'd expect to be seeing. So anyways, okay, I'm going to turn over to you guys and let you guys kind of run through a few of these. I don't know who's up next. Are you up next?
Yeah, I'll talk a little bit about inflation. And honestly, I've been talking about this a long time. So obviously we've got headline inflation and core inflation here, this is CPI, and then we have some data on PCE. PCE is really what the Fed's focused on, although interestingly enough, Powell even said that well, we're looking at CPI as well, because that's what people feel, right? They're looking at headline inflation.
And what's PCE for people who don't know what that means?
Really, honestly, it's a calculation of inflation that factors in substitutes versus CPI. So for example, if you go to the store and you want to buy maybe you have some cheese that you really like, but now it's gotten a little bit more expensive, it may actually substitute that cheese for another cheese. So it's a little bit more exactly. It's a little bit more nuanced, and I think it's more accurate because it takes into effect or into account that people will change their behavior based on inflation.
And one of the reasons the Fed likes this is because high-end consumers might not buy the generic brand. So you might not see it in the regular headline number, but in the PCE, you're going to see a broader representation of what the whole country is doing.
And the reality is, even with CPI, I mean, you're seeing core inflation starting to come down. And I know everybody's worried because they see the headline inflation kind of tick back up here. But the reality is that headline inflation typically follows core. And I think that we're starting to see that. And so you're seeing core PCE starting to come down. And I think for me, I think when you look back, and I know there's all these worries about inflation and people comparing it to the 1970s, but the 1970s was like a dragon. And in order to fight that, they had to go nuclear, and they had to increase interest rates massively in order to fight that. And it was a different kind of inflation because it was a demand-driven inflation, and it was a really reinforced psychologically by people who would sit there and they would think to themselves, I'm going to buy something right now because I don't want to pay 10% more in 6 or 9 months. And you don't have that psychology right now.
And so let's elaborate on that for a second, because I think it's really important. If you're worried about inflation and you're worried about hyperinflation, because I remember as a young person in the 70s and early 80s, this was a massive part of daily life. Why is it not that way now? Why are we not worried about a 70s style of inflation?
Yeah, I mean,
what's different?
I think the psychology is different, and I think that this inflation, we were talking about this before, it was supply driven. There was all the supply chain issues really drove this inflationary print. Whereas in the 1970s, it was much more demand. Now, obviously, there's an element of demand, but it was much more supply than demand. Yeah. I think another thing that's just structurally different in our economy is that we're not as goods based of an economy as we were. We're more services versus goods, and so I think that those two factors are big factors.
I also think a big part of it is just what we've been through over the last couple of years. this kind of lurching, back and forth between, inflation, deflation, supply, demand chain issues, too much inventory, labor tight, labor plentiful, it's everything has just been sort of this back and forth.
Plus, we did some things that we've never done in economic history, right? We dumped an insane amount of liquidity into our economy in one shot. It was like the COVID experiment has no parallel, right? Because you simultaneously shut down your economy, so you're going to have a jillion supply chain issues, and then you just dump cash into the economy. Like it's an experiment that we're working through and working off, because when you look under the hood, so much of the inflation was actually caused by that.
I think there hasn't been enough discussion of that.
I agree. I agree. Because if you look at January 2020, before we go into COVID, we were not running on a high inflation trajectory. In fact, do you remember we were having conversations on this call about a little bit worried about deflation and drag? Yeah. Remember that? Yeah. Like at the end of like 2019. So anyways.
But again, we're lurching back the other way. We've been throwing like too much money.
I know. This is how you get oil dropped $30 in 2 weeks, because you kind of don't know where to go with it right now. I keep teasing with people. I was an economics major, and pretty much everything that I studied in school is not working. Yeah. Like that's pretty much like where we're at.
Even just owning bonds and stocks, right? Because historically, bonds will protect you when the market's down. It did not protect you. Now that will normalize, and that relationship will normalize, but it got disconnected.
And that's why I think we actually are in a period where maybe, I love your point, Monica, about these lurches, because a lot of people spent a lot of money recklessly coming out of COVID. But I think you could overcorrect the other way, where right at this moment, everybody woke up 6 weeks ago or so and said, hold on, I'm going to stop spending here for a little bit. And you get that's not normal. Yeah. So you get these really big data swings, and we're looking through the charts right here.
Companies are doing that. Anecdotally, I hear tons of companies that are they're right sizing their workforce. They're saying, hey, we're actually not going to hire as many, or we're going to actually start cutting headcount. And so
both Amazon and Walmart said last month they are overstaffed. Yeah. When did we last hear that? We got to a place where Amazon was paying guys to drive a van around 150 grand a year. And then as of 5 weeks ago, they're saying they're overstaffed.
Exactly.
And that's a big important input.
Which tells me, honestly, and to the Fed's credit, I think the Fed is doing the job that it's supposed to do. It's supposed to cool the economy down. And it was almost immediate. You saw interest rates rise. As interest rates rise, sentiment changes. Yeah. Now you're seeing things cool.
I think it's working actually better than a lot of people think it's working. Yeah. But the one irony of the whole thing is all of us agree we're probably in a recession already, except the Fed. But everybody else in the world's like, I think we're already in one. But
on a real basis, right? And it's hard. That's right. It's hard not to be, honestly, in a recession, a technical recession, when you have inflation prints in the high single digits.
And then coming off the growth you had last year, you almost have to have a negative print.
I like this chart. This is interesting. This is out of JP Morgan, but basically breaking down inflation, and we've talked about this in the past, the main drivers of inflation being energy, new and used vehicles. Obviously, right, food has really over the last definitely over the last 6 months has become a bigger driver of the inflation number. But the reality is this is not going to be sticky inflation. And then you have the other inflation, which, shelter, obviously, right? Home prices have gone up, rents going up. That is going to be stickier inflation. And I think through this economic cycle we're in, the average inflation number is going to be much higher than it was in previous economic cycles. But it's not going to average in the high single digits. And a lot of this stuff is actually going to be, energy. That's going to be deflationary. You can't have a 20% drop in a month in oil and not have that in 12 months factor into the inflation numbers and be deflationary.
Well, the Costco down the street from my house has dropped gas prices 45 cents a gallon in 3 weeks. Right? That's fast. Yeah. That's a fast move. Yeah.
So you fast forward and you're going to see, like I said, inflation is going to be higher, and it's going to be higher than I expected. If back up 12 months, I would have thought already inflation would have been starting to taper off more than it has.
And these have always been the more volatile parts of inflation in the economy. And it's why the Fed looks at a core number that takes food and energy out, because we've always known that these go up and down like this.
And I do think one of the things that's happening, and Monica touched on, I think this is really important. The cure for high prices is high prices. How much is somebody going to pay for an airline ticket? It's right now, like just in the past 2 weeks, like I'm on planes now that aren't full, and they were just jam packed because the airlines are saying, where can I set the price so that I can maximize? The same with housing. We're just getting to a point where I'm hearing lots and lots of people say, I can't afford a house.
Right.
So I'm just gonna stay where I'm at.
Yeah,
I'm gonna fix it up. I can't.
I'd rather rent.
Yeah, I can't. Yeah.
Right.
Yeah.
Interestingly, what I'm hearing, that builders are not, they're being much more sticky on prices right now, just because they still have so much pent up demand for building that they couldn't fill a year ago, and they're not dropping.
Well, when you listen to the earnings calls of the builders, they're being really disciplined. Do you notice that this cycle, they're not overextending and overbuilding out in front of themselves the way they have in last cycles, where there's this collapse at the end? They're getting cash up front. They're making everybody go slow. They've used the supply chain thing to their advantage, so they don't get stuck holding the bag, so they can be a little more disciplined.
Yeah. And I think all of this, the lurching back and forth, that we've talked about, is what's making it very, very difficult for the Fed. Obviously we're always very in tune with what the Fed is doing. And it's funny, I had some conversations last night when I was giving a presentation with some folks that are, they're pretty attuned to these things, but they're not necessarily people who are in the market and watching it all the time. And they made the comment, a few of them, to me, that, all of a sudden Fed watching is a thing again. And I was like, when was it not a thing? It was not it was always a thing for me.
Right.
But they're kind of right. And that there wasn't as much attention placed, obviously, when things were going well, and there wasn't a whole lot to do. Right. And inflation was, almost negative, when we were more worried about that. And so this, period that we've had of zero interest rates and all of that, to people who haven't been in the market that long, now that feels normal now. And so all of a sudden they're very concerned. Oh my gosh, what if we get a 3% Fed funds rate? Well, to me, that's more normal. Over 30 years or so that I've been looking back to see, the interest rates where we have them right now on, even treasuries and corporates, they look stunning compared to what they were a year ago, but they look more normal to me over a 30-year period. So I almost feel like we are kind of, maybe, hopefully, put that in quotes, returning to some state of normalcy, and we have not been in
I think that's exactly what happened. I think we were living in la la land at zero interest rates, zero inflation,
money everywhere,
just dumping cash into the system, and it's completely unsustainable.
2.5 mortgages. I mean, that's nuts to me. Yeah. So I think that it's all made it very difficult for the Fed. We're showing here the median policy rate projections for the Fed by meeting, and of course you can see that the Fed's idea of where they want that end rate to be when they're done has been going up and up and up. And again, a lot of people look at 3.5 on a Fed funds. Oh my goodness, if we get to there, the world's going to come to end. Well, we've been there many times, and the world didn't come to an end, and it probably won't. But another thing to consider, though, is, again, looking back over many years, the Fed is notoriously bad at making these projections. They're usually not right, and they do tend to overshoot a lot of the time as well. And so, this is just looking at the futures implied rates. Again, I think that in the last really just a couple of weeks, the market has become very pessimistic, of course, worried about recession, and worried that the Fed is going to overshoot that and clamp down on rates way too much. And so the market has started turning those projections around for itself, but the Fed is still saying they need to do more. We think that they're probably going to still do another 75 basis points this next meeting. A lot of people think that they'll do it, but it's going to be too much. And they're going to throw us into this recession.
Well, isn't it kind of awkward? Because the Fed almost has to do it, but it's almost like it's like, because it's already priced into the futures market. It's almost like, from the credibility standpoint, the Fed has to do it, and almost everybody knows maybe we really don't even need to do it. It's like a box check.
And I think the discussion has been around mostly, what is their biggest driver? What is their biggest concern? Obviously, inflation is at the forefront right now. But yes, of course, they're worried about the economy going into recession, or worried about hurting the labor market. They have to be, thinking about those things. But if we haven't really seen the numbers yet on that, we're talking about a lot of anecdotal things. If we haven't really seen the numbers on that, the slowdown and hurting the labor market, then are they really going to have to still focus on inflation? I think so. I think that's still going to be their.
What bond traders are pricing in is more hikes this year, but now some cuts out late next year,
March of 2023,
to reverse that.
Forecasting cuts.
Yeah, absolutely. But you know, where we are with rates right now, it's really interesting. Again, going back to that discussion I had, you know, with some folks about what's normal and what's not normal. You know, we were looking at talking about some of the interest rates we're seeing, even like fairly short-term investment grade bonds, we're getting over 4%. Even under a year, we're getting 3%. I mean, that's just, it sounds crazy to people, but again, it feels more normal to me in a historical complex. But particularly as the markets have become more and more concerned about recession, it's keeping a lid on the longer term rates, and we're really just seeing the action and the increase on the shorter term rates. So the most dramatic moves have been on things like our cash management bond ladders, where we're getting much better rates. The rates on the intermediate term corporates, high yields have popped up a little bit. The spreads have widened. Josh is going to talk about that a little more in a bit. Really, I think related more to the recession fears than anything. But again, even at the levels they're at now, they feel more normal from a historical context. So, you know, again, this is just showing again how the Fed tends to overshoot a lot. We're looking at their rate projection versus the actual lower bound, big difference between that. And, you know, and it says, you know, the Fed seems hawkish. And the last time they hit this sort of peak hawkishness back in 2019, you know, obviously after that point, rates dropped. So, you know, you have to think about, yeah, they can be very hawkish, but then rates can still drop.
And that was, for those that remember, like that, you know, December of 2018, the Fed hiked.
Yeah.
That was the month where the S&P was down, you know, whatever.
Freaked out. Yeah.
15% in a month.
Going into Christmas, it was like pure panic.
Crazy. And then obviously there are other things, the government feeding into that. But then it was interesting. Yeah, you look at that meeting and their expectation for 2019 versus reality, and that I would argue was peak hawkishness for that cycle.
So reading this chart, what it says
December of 2018
is the Fed was anticipating that kind of rate environment, and this is what we got to.
So in December of 2018, by the end of that year, the Fed, or you know, in December of 2018, Fed was expecting about 3% by the end of the year. But what really happened, 1.6%.
Yeah.
And then by obviously we know what happened in 2020, and so
And again, you know, the Fed is notoriously bad
at
calling rates. One other thing I want to mention before we pivot a little bit, and Josh is going to talk about spreads, but you know, just the idea of whether we're in a recession or not in a recession. And you know, I was reading some things earlier about how the general markets, really in general public, sort of think of a recession as 2 quarters of negative, you know,
GDP growth.
Negative GDP, right? And so, you know, the Bureau of Economic Research actually calls that. They decide what it is, and it's partly that, it's partly other things as well. And interestingly, they've never called a recession where we had an increase in employment. And we haven't had a decrease in employment yet. I mean, we still have pretty good non-farm payroll numbers coming in, and a great unemployment rate. I mean, and
earnings too are holding in, right? Earnings, employment. I mean,
and we haven't seen negative inflation yet, to our point earlier.
Right.
So, you know, are they going to really be able to call it a recession? But then, you know, at the end of the day, it almost doesn't matter.
Yeah.
To most people, because it's not going to determine where the stock market
goes. And I think
goes.
that is the exact point, Monica.
Yeah.
Right? Does it really matter?
Yeah.
We're putting names to it.
Yeah.
The bottom line is we need the economy to slow so we get that inflation back under control. And it will be, if we can do that, it's great for the economy going forward, right? I mean, that's the point.
Yeah.
Yeah.
Absolutely. So turn it over to Josh.
Yeah. So, I mean, and we've talked about this, right? Yields have come up. This is the spread over the treasuries for high yield bonds. And so you've got, you know, the line here is the 10-year average, and you see that we're quite above there, right? Almost 6% or 600 basis points of spread versus the average of about 450.
Put that into nominal terms for our people that are joining us today. So if you buy a basket of mid-grade corporate bonds, what's the interest rate from like 2 years ago till now? Just like,
and honestly, here this chart will show, right? So in 2020, high yield bonds, or you know, you'd be getting paid like 4%. And what are you seeing right now? You're getting paid close to 9%.
That's incredible.
Which
is
a
massive move.
And you know what's funny is when I was pulling this data, I thought to myself, you know what? Long-term average should be, when I think of high yield, I think 6%. Right. That's like the normal environment. And then when I ran the data and I looked over the last 10 years, it was literally spot on.
Really?
6% is
That's
the
because
average
you're a
yield
young
in
buck.
that.
I think high yield should
You're
be
like,
like
I know.
7.5%, but 30 years in this. Yeah.
But
But
again, it goes back to my point of this is starting to feel more normal.
Normal.
Yeah.
Exactly.
And the last 5 years was not normal.
And I would almost argue it's actually attractive.
Yeah.
I know we
Absolutely.
don't want to make market calls on this, but I do think that investment grade
Absolutely.
and high yield bonds.
The only way it's not is
look
if you
attractive.
think inflation stays over 6
Mhm.
and or you think there's a massive deterioration in credit quality, one
Yeah.
or the other, right?
Right,
But
right.
it's getting very interesting here again. Like
Yeah.
it wasn't just
And-
1 year ago. Everyone had written bonds off for.
Yeah.
They were like, I'm never buying bonds again.
Exactly.
Well, look at this. This is compelling.
Yeah.
Like,
And these
that's compelling.
peaks, this is where people are really worried. That's
Yeah.
that's the fear factor there,
Yeah.
and we're
Yeah.
not there yet.
yeah.
Yeah.
Okay. All right. So let's bring it home. This is, of course, we get asked a lot, especially about the stock market. Have we bottomed? Have we bottomed? Are we close to the bottom? Like, how much more pain is there? Of course, nobody knows, right? People get on these calls and they want to give you your S&P 500 forecast for the year, which I always scoff at. It's a sucker's game. Like, nobody knows, right? But we know, but there are things we do know. Okay. And when you look historically at really big sell-offs in the market, and by the way, here's the last 3, but I can keep going all the way back. I started in the business in 1992. I've seen 23 corrections in the stock market of 10% or more. The big ones, these are the hallmarks. You usually see most of this list being checked off before you can really get in there and feel more confident about a market bottom. Of course, you don't know. Nobody, a guy that I used to trade with in New York on the floor used to always say they don't ring a bell at the bottom and they don't ring a bell at the top, right? So you don't know, but we can check some of these things off. And compared to January, remember we had the big January sell-off going into the end of the month. We had another big sell-off in March. Both times we bounced. We had another big sell-off in June. We're seeing some of that right now, right? But the list of items we're checking off is getting better. There's more pessimism. There's more fear. You're taking a lot of the excess out of the market. Now we're sitting around mocking things like NFTs and crypto, right? Which is exactly what we should be doing, which is before we were humoring them, right? You're seeing a lot of people come on TV and say the world is ending. I like seeing that.
Yeah.
Usually that's you're getting near a bottom.
I've seen a lot more articles.
Oh,
The
yeah.
market's going to be down another 30%.
Oh, yeah.
That's a good sign.
Yeah.
That's a good sign.
Yeah. If the average stock is down 39% and people are calling for a 30% sell from here, the fear mongers are out, right? I'm going to show you a couple other things that are totally insane. I'm going to skip some of this stuff going into the bell here, but there's one I really want to touch on. This is a big deal. Okay. So you can cheat a lot of things, but you can't cheat this. This simply what you're looking at says, if you take a company and you add up all of their cash and their short-term investments, because companies will keep they'll keep assets even in treasuries, right? Monica manages a lot of cash management programs. It's not technically in cash, but if you look at companies, you take their cash and you take their short-term investments and you compare it to the value of all their shares outstanding, their market cap, which you could go out and buy every single share at right now. Look at this. This is insane. 12% of companies that trade here in the US are trading at that level. Okay, I don't want to say the stocks are cheap because they can get a lot cheaper from where they are, but they're not what they were. And we're starting to see a lot more value. And what is something that's really common with these red circles? Those were all big market bottoms. And I mean big bottoms, like market rallied for several years sort of after those data sets. Consumer sentiment, that is an all-time low. This is the longest running economic and consumer sentiment survey in the United States. It goes back to the 60s. There's never been a print of 50. Even in the early 80s, even during the financial crisis, historically, this has been an amazing time to start looking at risk assets and think about things that you want to buy. I'm going to skip around a little bit here. How expensive is the market? Okay, this is 10 years of data here. We got incredibly expensive coming out of COVID, right? Because earnings were terrible and stock prices were still going up. The pendulum is really swinging the other way. Here's the COVID low, right? So this is how expensive the market is. This isn't the level of the market. This is the expensiveness of every share, right? We call it the price to earnings ratio. And so earnings have kept going up. And so quickly the market has gotten cheaper. This is getting much more interesting under the 10-year average. Okay. This is something we talk about a lot. I think I might have shown it a couple of months ago on a call. I wanted to show it again. This is a big deal because when we all hear it in our business, when markets are screaming like in early 2021, my phone is ringing with people asking me about SPACs, crypto, NFT, right? Startups I've never heard of,
capital, yeah.
technologies I've never heard of, right? And that becomes what people want. It's hot, 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 right? Okay, look at this. In the last year, if you take the 3,000 biggest companies that trade on US stock exchanges, look at the damage that has been rendered, okay? The lowest profit margin companies, right, are the ones that have been absolutely destroyed. And you stay up here in these high profit margin businesses, and okay, so it's not sexy, right? And you feel like maybe you're missing out a little bit like in 2021, but this is where I want to be hanging around the hoop, is right here. I want the core of my portfolio in these really high quality businesses that are hard to compete with.
This is when fundamentals matter.
Yeah,
right?
It's quickly fundamentals matter again, right? I do want to, kind of note, and we like to point this out when markets get volatile, that is as unique as the conversation is right now, it's also totally normal. Markets every 3 or 4 years, they have some kind of big sell-off. What happens is, what does Warren Buffett say? Basically shares go back and find their rightful owner at times like this, right? You shake the stocks out of the weak people's hands, so to speak. And this really sets up the next leg for another expansion. And we're in one of those right now. We got in this range between 20 and 30% down. Okay, so we kind of want to end with this. This was sort of our checklist, but let's skip over that and get everybody back on their day. So our working thesis is the economy is already slowing down a lot more than the rear view mirror data is showing us. And we showed a lot of charts on that. We spent a lot of time on that. Fed probably doesn't need to hike as much as the futures market has in it right now. Almost certainly more hikes coming, probably not quite as much as got priced into the market to begin with. High probability of some level of recession and probably a small probability of a deep recession. Probably more bad things would have to happen that are not even on the radar right now for a deep recession. From what we see that's out there, the amount of cash, the labor market, earnings, and all those kinds of things, it looks like it's the kind of slowdown that you want to have. Earnings probably have to be adjusted lower. We haven't seen a lot of adjustments in earnings. So don't be shocked when you hear, analysts saying, well, we don't think earnings are going to be quite as good. Well, most of us already know that's the case. So we're already bracing and anticipating that earnings estimates are going to come down a little bit more. We are probably going to have some lagging inflation. Anywhere where you see these really quirky supply chain problems, like maybe in crude oil, like it might be hard for crude to get back down to $50 a barrel anytime soon, just given what's going on in Eastern Europe. We're not pulling it out of the ground in the same way we could have a few years ago and things like that. We talked about housing. We definitely don't think there's a housing crash or any kind of big sell-off coming, but a cap on pricing and a better, more liquid two-way market in housing. As you finally get people wanting to sell, even lowering the prices to sell some, and you get buyers sort of slowing down and being a little bit more cautious and responsible. And then ultimately for stocks, definitely could take another leg lower. It's impossible to say where the bottom is, but we are getting through a lot of the damage. And we're starting to see some really interesting things in equity market behavior. Like yesterday on the open, it was really ugly. Like it was a bloodbath yesterday on the open. And then by the end of the day, you're getting a consistent bid all day long in the tech stocks and the stocks that have really been beaten down. So I think people are starting to recognize there's some value here. And guys that I haven't seen in there buying in a long time are in there buying again. So we'll kind of leave it with this in terms of a game plan. You'll want to talk to your advisor about the specifics of your portfolio, but these are great opportunities to rebalance as needed. There's some kind of chance that you either owned not enough growth assets over the last 10 years or you own too many. And in the last few years, you found out one way or another maybe where you were at, right? We want to avoid complacency. Be intentional in what you do. Hope is not an investment strategy. I hear too many people say, well, it went down. Now I don't watch it anymore. Like there's this attitude, like I'm just ignoring everything. Okay, please don't do that. Be intentional in what you're doing. And if there's something not built properly in your portfolio, let's get it fixed so that in the next bull market, you are the beneficiary of having a good portfolio, right? So Be intentional, right? Know what you own and why you own it. Don't just blindly buy things. And by the way, I'm not just talking about your 401k. I'm talking about your brother-in-law that comes to you with some cockamamie business plan. Be disciplined, be careful, really do your homework and know what you own. And owning high quality is just something that we have on this list 24/7, 365. There's a room in everybody's portfolio to take high levels of speculation in assets that are really unproven kinds of assets, but the core of your portfolio has got to be in those really high quality bedrock kinds of investments. And by the way, that's in everything. It's stocks, it's bonds, it's real estate, it's in a variety of different asset classes, right? We're going to probably have more volatility. I don't think we're out of the woods yet on volatility. We got midterms coming up. There's a lot of crosswinds. We still have what's going on in Europe. And of course, what's going on in the crude oil markets and things like that. And then trying to get our heads around inflation. Monica's point about we've got to see it in the data. But here's what I will say, and you're not hearing anybody talk about this anymore. And that's why I'm starting to get a little bit more bullish. And that is that you actually have a market that could rip. Okay, because you have such awful news priced in. What if the next inflation print is way off? What if it cools quickly? People will race in and try to buy risk assets. So you want to be kind of out in advance and intentionally doing things with your portfolio here. A lot of cash on the sidelines, right?
I'm starting to hear a little bit more discussion about whether the Fed might be a one and done thing. And we don't know what the one is. Maybe the one is one more 75, or maybe, maybe we're already there.
Or whatever.
But if that were to happen, if we get to that point where the Fed just said, okay, we've done enough. Then that could be another catalyst.
Because you could actually see us all talking about on the next call. Wow, earnings held in really well. The consumer still looks great. We got the cooling we needed in the labor and the housing market, and inflation had a big drop. It's time to party again. Like, you could see us having that conversation in the next quarter.
Fed hiked once, and then now they're just data driven.
Right. Fed says we're going to wait and watch now. So don't find yourself getting too pessimistic, because this can flip the other direction as well. And then, of course, don't abandon important asset classes. Last year, I heard people just writing off for dead bonds. Bonds are really interesting here again. So again, be intentional. All right, I'm going to shut up. Anything else you guys want to add?
We've got a few questions.
Okay, absolutely.
So, how much of the cash stockpiled? Oh, sorry, I'm going to go back one more. How have margin balances been affected by the downturn? What effect does this debt have on the economy as a whole? I'll be real quick. The margin balances peaked October 21, 935 billion. In May, 753 billion for margin balances. Pre-COVID levels was like 500 billion, so about $500 billion. So it's definitely come down. But the reality is also probably people's net worths have come up. So I would say margin balances are definitely normalizing. I don't think it's going to have a massive effect on the economy.
Let me add one more thing to that. I saw a chart the other day that showed margin balances as a percentage of GDP, not a nominal number, and it's actually making a cycle low.
And that makes sense, which is how,
Because net worth, to your point, net worth has gone up so much.
So not big concerns there. How much of the cash stockpiled is a function of the government spending programs?
Here's what's interesting. Less now than you think. And I want to be clear what this question is, because it's an excellent question coming from Donald. Okay, we've seen most of the, and let's just say it, we've seen most of the lower income cash piles already get blown up and worked off.
Yes.
Okay, but the vast majority of the 9 trillion is in the upper half of net worth in the United States. And believe it or not, most of it's in the top 10 or 20% of net worth in the United States. So it is skewed.
And the other factor is corporations. Corporations are sitting on a ton of cash too.
Yeah, absolutely.
And that didn't come from the government. That just came from their discipline. And hey, we know that things are going to be bad, so we're going to issue debt. We're going to stockpile cash. And now they've got a lot of cash that they can deploy.
So Donald, our answer is that there is some from the government spending programs, but a lot less than there was 4 quarters ago. A lot of that has already been put to work and was what contributed to the inflation. Right.
Totally. How do you suppose the food crisis is affecting the markets?
Yeah, who wants to take that one?
That one's tough. I mean, I think the commodity prices ran hot because out of expectations, which always happens in markets, right? And they're coming back down because I think reality is hitting. and obviously this is a tragedy in those parts of the world that are dealing with this. But I've also been hearing anecdotal stories of a lot of these countries shifting away from maybe wheat and starting to import rice or doing different things in order to try to deal with this.
And I think the food crisis is not going to be as bad as we originally feared. And all of the commodity prices are telling you that. Wheat's not crashing for any other reason than the market's saying there's plenty of supply.
Yeah.
We can feed people.
Yeah.
The other thing on this, Sherry, and it's a great question, is that that's more of a humanitarian disaster than an economic one. As sad as it sounds, historically, food crises have not actually had major impact on global GDP and economic output. It's actually more of a humanitarian issue.
Yeah, I think for most people, they have access to substitutes, as Josh mentioned, they can substitute things, and they've had the cash pile so they can handle these disruptions in the pricing, if you will. It's more at the lower end, like you said, it's a humanitarian crisis for those who don't have
low
access
GDP
to that.
prints anyway.
And,
Okay. Next one, any idea why commodity prices are plummeting? Has demand really gone down for foodstuffs? I mean, a lot of commodity prices, right? It's expectations. So all the metals, right? Copper, gold, silver, all this stuff has gone down because of the expectations of a potential recession. Mm-hmm. Oil, definitely, you look at oil the last 2 days, it's gotten destroyed. And that is purely based off of the perception of the market that we're potentially going to head into a recession.
And it's really not, Scott, to your question, it's not so much there's all this new supply that came online in the commodities market, as much as we overshot fearing there would be no supply. Yeah. And now quickly demand is slowing. So there's enough supply and demand slows a little bit.
Any data on this, but it seems like there probably has to be a factor of, this had become sort of a self-fulfilling prophecy where when people got wind of, oh, there's supply chain issues, there's going to be shortages, they go out and they hoard things.
Yeah, 100%.
And everything from 100%. Huge commodities down to toilet paper.
Yeah. And
it drives up the price.
The baby formula, like that phenomena happened for sure.
When as soon as there was even a minor shortage in baby formula, then all the shelves were empty.
Exactly.
Everyone ran out and hoarded. We saw the same thing coming out of COVID. It's one of the reasons people don't need to buy freezers right now. They all bought an extra freezer coming out of COVID.
They don't need another one.
No, I don't need another one, right?
If supplies increase, where is it coming from? I'm not sure if that's related to commodities or whether that was housing. So let's just skip that one. Scott, you can reach out directly. And then Kim, let's talk about that one offline. Just short-term investments.
Yeah, questions about energy investments. And energy investments had really been leading the year. They were the one place that was like this great silver lining. So much, Kim, of the when you look at investments in energy are really contingent upon what the commodity price is doing itself. So they swing so wild. Investing in energy is hard business. You typically want to invest in energy when it's hated and sell it when it's loved. I mean, that's really, so the outlook could still actually be quite good in energy because you might not have real supply resolutions anytime soon. It's not like we're going to be dumping oil into the market.
Sell-off.
Yeah.
Because the reality is all these energy companies are still being fairly disciplined.
Oh, yeah.
I think this recent sell-off obviously related to recession risk, but also the zero COVID policy in China is obviously, continues to batter the market.
And we still have a U.S. government not very friendly to drilling.
Yeah.
Right. And we still have problems with Russia and Ukraine that are crimping supplies out of Eastern Europe. So the problem is it's going to be wild. You're probably going to have these massive swings in the energy complex for a little longer, Yeah. Is that it? All right. Hey, everybody, we're so grateful that you make us part of this and part of your portfolio and your retirement plan. And really, thanks for taking a few minutes this morning. It's a great way for us to disseminate information quickly to a lot of people. And obviously follow up with us or follow up with your advisor if we can fill in any more gaps or comment on anything, and have a fantastic summer. Stay safe and enjoy it. We'll talk to you on the next call.